the first move I made since the crash happened is to buy Twitter calls dated to June 2020. Now, why did I buy Twitter out of all the companies I could have bought? As everyone's down. Well, you got to talk. Obviously, we had to talk about the coronavirus and the effects on the company. Now, the primary thing I see with this virus is just massively increased news consumption. This is probably the biggest news producing and consuming event that has happened in modern history, greater than 9/11, simply because of the scope of the event. It's worldwide rather than just in New York or just in America, and it's like a prolonged event that will happen over the course of potentially a year instead of a discrete event, which its effects sort of tapers off over time. So mainly, I see this as sort of reinforcing something that you and I know. You're probably watching this on my Twitter feed. Is that Twitter is simply the place to go if you're trying to get caught up to date on the news. There's no other website, unless you're specifically going to the New York Times. You can find all of the New York Times stuff on Twitter. As a responsible news consumer, if you want to aggregate multiple sources, you go to Twitter to aggregate that for you. So this will be probably just a massive increase in Twitter. They measure their users by this thing called an MDAO, monetizable daily active users. It's basically, you're counted if you're not a bot. So this number will go through the roof. Surely, the number of users they have over this period of time will increase dramatically. Now, the downsides, everybody knows. Everybody knows about the downsides. You want to hey, aren't they going to miss earnings? Yeah, they're going to miss earnings. But everyone knows this. This is what's priced in. If you take a look at the price, on February 20th, it was trading at $39.05. Right now, as of Thursday, what's the date? Thursday, March 19th, it's trading at $23.09. This is basically a 40% drop. Now, if you take a look at some other company, if you take a look at Apple has dropped less than 25%. Now, there's no mental gymnastics you can do to spin the coronavirus as any sort of positive for Apple. It's just a pure negative, yet it's dropped more than Twitter. Now, there's no bankruptcy risk here, so why is that happening? Even the price on its own is probably enough to justify buying Twitter stock, even without any of the positives I just mentioned. The virus, a half-year impact, maybe a full-year impact. There was nothing wrong with the economy before, so when it comes back, the stock dropped 40% for potentially a year lost of growth, which does not make too much sense to me. So that already screams a buy. Now, excluding virus, let's go beyond the virus. What else was happening with the company? Now, previously, in January, I sold all my Twitter stock I had before because earlier, I think Twitter made the decision to stop political ad spend, which is insane. What do you use Twitter for? You use Twitter for news, you use Twitter for politics. Now you're going to stop politicians and political groups from spending money on your platform? It's stupid. It's the CEO is not trying to make money. So, I mean, a bunch of people must have thought the same way, because you got a bunch of activist investors coming in all of a sudden. And, they demanded changes to the board. They demanded changes in the company governance structure. They even wanted Jack to step down. And Jack did not end up stepping down, but these companies they got some serious changes. I think they got 2 members of their board. 2 activists got onto the board. And I think Jack made some additional concessions. And they've committed to a $2 billion buyback. Now, this is absolutely the perfect time to do a buyback. They got so lucky with their buyback timing. When the stock is down 40% versus what everyone else was doing when they were buying back stock at all-time highs. They could not have asked for a better time to have a $2 billion buyback program. So this is fantastic news. They got lucky. Everyone got lucky with this. Now, you might be out there saying, Twitter, this is a software company, this is a Silicon Valley company. Won't these Wall Street guys ruin, the company like they ruin other Silicon Valley companies? Now, I'm a software engineer myself. In general, I agree with this idea that I'd rather have a Silicon Valley-led software company than a software company that's being micromanaged from the street. But no, you have to take a look at the pros and cons of Silicon Valley versus Wall Street and see which one applies to Twitter in this instance. Now, if you take a look at a Silicon Valley company, they develop fast, they rapidly iterate on their products. There's constant development, there's quick change, they make innovation very fast, but they burn a lot of money, and maybe they don't make as much money as they should. Now, a Wall Street-led company, they take an existing product and they figure out how to correctly monetize that product. They optimize monetization for existing products. The rate of change goes way down. Now, that's what everyone's afraid of. But if you take a look at Twitter as a company, which model is best? There's been no changes at Twitter. Twitter is not a company that makes substantial improvements to their product at all. Take a look at the last year. Try to ask yourself, what have they made? What changes have they made to their product to make it better or to do anything with the product? I don't think you can think of any. The last change that anyone can think of when they think of Twitter is like 2 or 3 years ago when they increased the character limit from 144 to 288. I mean, like, there's not much to justify, high, engineering spend. This company is not changing. What they have a mature product, but they do not have a mature business, or like they do not have a mature monetization strategy. So it makes complete sense to me to bring in some Wall Street guys or to bring in like some consultants and whatever and take a look at the mature product they have and figure out how to squeeze some money out of it, because they are absolutely not making as much money as they should be making for a company that is as prominent and ubiquitous as Twitter is. So yeah, taking some sort of like switching mindsets a little bit from the valley to the street is definitely a good thing, in my opinion. So, sort of in conclusion, this is a company that took a massive hit from the virus, even more than, players like Apple or Microsoft. When the effects of the virus are temporary, and the virus is actually, in other ways, good for the company. And also the long-term governance changes that were made right before the virus hit have been completely overshadowed. It's like everyone forgot about that, and everyone just panic selling because the market as a whole is going down. So I'm pretty sure by my call expiration date in June, this company should go whoop, and I should be well in the money. I think I bought yesterday. It was like 24 strike. They were out of the money. It's up like 9% today, so I'm already in the money. But of course, I mean, that's the short term. It's choppy, but by June they should be priced in, and you exclude any election risk, because this company, more than any other company, depends on the re-election of Donald Trump, and that's completely up in the air at this point. So by June, everything I discussed earlier should be priced in. The company stock, I imagine, will be up, and you don't have to, you exclude any election risk. So that's the reason for the June expiration, and that's the reason I chose Twitter as my first buy.